Have you ever walked away from a massive financial deal feeling like an absolute winner, only to realize years later that you missed the bigger picture entirely? Welcome to Dollar Playbook, everyone. I'm Taylor Reed, and today we're going to explore a very relatable real-life scenario to uncover the hidden profit mechanics of the mortgage industry. We're looking at a system that touches almost all of us, yet it remains largely invisible. But by the end of this explainer, you are going to see your mortgage and, honestly, your money in a completely different light.
So, to understand exactly how this machine works, let's look at two coworkers, Greg and Elena. Now, both of them walked away from the exact same lender for the exact same $300,000 loan size in the exact same week, and they both thought they got a fantastic deal. Greg proudly negotiated his interest rate down from 6.75% to 6.25%. Elena, on the other hand, she brought a massive 40% down payment upfront, assuming that cold hard cash gave her all the leverage she needed. But in reality, both of them fell victim to an invisible profit machine. In fact, Elena actually ended up paying $7,800 more over the life of her loan than Greg did. So how is that even possible?
To demystify this whole system, our explainer today is going to guide you through 6 straightforward sections. We'll cover the profit illusion, front-end layers, closing table fees, the post-closing payday, how lenders test you, and finally, your negotiation strategy.
All right, let's dive into Section 1. The mortgage profit illusion, why the rate isn't everything.
We've all been conditioned to believe that fighting for the absolute lowest possible interest rate is the ultimate victory in real estate, right? You check rates online, you haggle with the loan officer, and when they drop the rate a fraction of a percent, you feel like you just won the game. But here's the hard truth. That rate is just the illusion hiding the real transaction. Think back to Greg. Even though Greg negotiated his rate down and drove home from closing feeling like a total winner, especially after his loan officer told him they were barely making anything on the deal, the math tells a completely different story. The lender still made over $11,000 on Greg before he even made his very first mortgage payment. Let that sink in. $11,000. And Greg never saw a single dollar of that profit clearly itemized for him.
Moving on to Section 2, front-end profit layers, the first bucket of fees. So to understand how that massive $11,000 profit is even possible on a loan where the lender supposedly made nothing, we need to look at the first of 3 chronological buckets of hidden money. The most expensive front-end layer is something called the yield spread premium. This is basically the invisible markup between the lender's true wholesale cost of funds and the actual retail rate they quote to you. If a lender can get money at 5.75%, but they quote you 6.25%, that gap, that's pure profit. To put that into perspective, on a typical $300,000 loan over 30 years, just a 0.5% markup translates to roughly $32,000 in extra interest. So when Greg negotiated, he didn't eliminate the markup at all, he just made it slightly smaller. And along with that invisible rate markup, lenders stack on other front-end layers. They'll sell you discount points, which, by the way, most homeowners actually lose money on if they move before the 5 to 7 year break-even mark. They also charge origination fees ranging from $1,500 to $3,000, which far exceed the actual labor costs of their automated systems. Oh, and they include rate lock extension fees. And what's really frustrating here is that extension fees are often triggered by the lender's own underwriting delays, yet you are the one footing the bill when the clock runs out.
Okay, Section 3, closing table, hidden fees, the second front.
After you finally survive the front end, you reach the closing table. This is the second most profitable moment for them because your guard is finally down. You're mentally exhausted, you've packed your boxes, you just want the keys to your new home, and honestly, you're ready to sign pretty much anything they put in front of you. That is exactly when you are handed a stack of documents an inch thick, absolutely filled with padding. You'll see processing and underwriting fees that cost up to $1,500, even though the actual human labor involved takes only a few hours. You'll see mandatory lender's title insurance, often routed through their preferred referral vendor, capturing another $1,000 to $2,000 in profit. Then there's the small ticket stack, wire fees, notary fees, courier fees. It's basically a series of paper cuts that easily add another $1,500 to $3,000 in pure profit for the lender.
Which brings us to Section 4, the post-closing payday, the real money.
Now, even if you were an absolute master negotiator and somehow got every single front end and closing table fee down to 0, the lender still wouldn't panic. Why? Because the most lucrative layer of all happens a couple of weeks after you sign, in a transaction you aren't even a part of. Within a few weeks of closing, your lender will likely bundle and sell your loan to the secondary market, to entities like Fannie Mae, Freddie Mac, or private investors. And when they do this, they capture what's called a gain on sale margin. On Greg's $300,000 loan, that secondary market sale instantly nets the lender between $7,500 to $10,500. Seriously, let that sink in. They make more money selling your loan to an investor than they made on every single fee at the closing table combined.
But wait, on top of that massive lump sum, the post-closing payday actually continues. They generate ongoing revenue by either keeping or selling your mortgage servicing rights. And then there's the escrow float. The servicer holds 6 to 12 months of your property tax and insurance money in a special account. They earn interest on your money every single day, and you don't see a cent of it. That generates $50 to $200 for them every single year for 30 years.
All right, let's look at Section 5, how lenders test you, the leverage trap.
Let's return to Elena for a second. Remember, she brought a massive 40% down payment, assuming that cash was her leverage, but it didn't lower her rate at all, and it completely destroyed her negotiating power on the fees, costing her almost $8,000 more than Greg. So you're probably wondering, why doesn't a massive down payment guarantee a better deal? Well, we're trained to think that in any transaction, bringing more cash up front gets you a discount. But a mortgage lender's completely different. The loan itself is the product. More cash down doesn't reduce the lender's profit margins, it simply signals to them that you're financially secure, emotionally locked into buying a specific house, and highly unlikely to walk away over a few $100s in fees.
Because lenders know this, they actually use a timeline of 3 subtle psychological tests to gauge your commitment. Test 1 is the pre-qualification call, where casual questions about your timeline reveal your flexibility. Test 2 is the pre-approval letter, a soft commitment that ties you to them because starting over somewhere else puts your closing date at risk. And Test 3 is the rate lock, where the clock starts ticking and they control the underwriting speed. Slowly, step by step, they strip away your leverage before you even realize you're negotiating.
Finally, Section 6, your mortgage negotiation strategy, taking back control.
Okay, take a deep breath. Now that you see exactly how this machine operates and how all 12 layers are stacked against you, I want to give you a practical, step-by-step strategy. You absolutely don't have to be a financial expert to do this. You just need to follow these rules to take back your leverage without feeling completely overwhelmed. A critical key to this strategy is a term you absolutely must memorize: the par rate. The par rate is the interest rate at which the lender's profit comes only from their standard origination fees and the eventual sale of the loan to the secondary market. It's completely without that hidden yield spread premium markup we talked about earlier. Asking a loan officer for the par rate immediately signals to them that you understand exactly how their markup system works.
So here is your playbook. Follow these 6 steps perfectly. Number 1, get 3 federally standardized loan estimates from different lenders without revealing your timeline, your down payment, or the house you've picked. Number 2, look them in the eye and ask directly for that par rate. Number 3, negotiate the entire fee stack. Processing, underwriting, all of it is flexible. Number 4, independently shop for your own title insurance. You can actually save up to 50% just by ignoring their preferred vendor. Number 5, secure your rate lock terms and extension penalties in writing. And number 6, ruthlessly verify your closing disclosure line by line 3 days before signing. If a new fee appears out of nowhere, challenge it. If you take away just one financial lesson from our time today, let it be this core philosophy right here. The rate is not the deal. The rate is just one single layer of a 12-layer machine. Negotiating the interest rate is merely the very first step in protecting your hard-earned money and building a truly stable financial future for yourself.
Understanding how these systems work is how everyday people take control of their financial lives. So, the next time a lender offers you a slightly lower interest rate, I want you to ask yourself, what is that rate really hiding? Thank you everyone for joining me, Taylor Reed, for this explainer. If this information helped you see something you didn't know was there, please like, share, and subscribe to Dollar Playbook so we can keep building a stable, financially empowered life together. I'll see you in the next one.